Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's class is related to Index 1, that is presentation and preparation of financial statement. I had also discussed this class in my previous, I won't be able to continue my channel due to some personal reasons. Now I am going to continue my channel. So I will give the previous class link in the description box for reference. So let's start our today's class, that is related to presentation and preparation of financial statement part 2. In this class we will discuss about the component of India's financial statement. What are the components in the India's financial statement? That is balance sheet, statement of profit and loss and other comprehensive income, statement of change in equity, statement of cash flow, significant accounting policies and other explanatory notes, comparative period balance sheet which we will restate. So in generally accepted accounting principles, we prepare our financial statement like we will make the balance sheet, we will make the profit and loss, we will make the uh, um, cash flows, we will make the significant accounting policies and comparative figure also. But in this, in India's financial statement, we will make the other comprehensive income, statement of change in equity, and the comparative figures which we will state in the balance sheet, which is also restated. And if we will adopt India's for the first time, we will make three balance sheets. So these are the components, and we also make the disclosures of various balance sheet items in the form of notes, PL item in the form of notes, and all the notes whatever we made a disclosure in the financial statement presentation. Like in balance sheet notes are PPE, that is property plant equipment, investment properties, intangible assets, financial assets, deferred tax assets, other non-current assets, equity share capital and other equities, financial liabilities, provisions, deferred tax liabilities, current tax liabilities, other current liabilities. All we will make in the form of notes. And also we will make the PL notes like revenue from operation. In revenue from operation, we disclose the other income, other gain and losses. Also, we make a note of cost of material consumed, change in inventories, WIP, stock in trade, finished goods, employees benefit expense. In employees benefit expenses, we will give the employees cost, that is salary, any kind of leave encashment, any kind of gratuity, whatever the benefit we are going to give the to the employee, that is to be disclosed under employees benefit expenses. Depreciation and amortization, other expenses, whatever the other expenses related to the company, we will disclose in under other expenses. Finance cost, if we pay any interest on borrowings, so we will disclose under finance cost. Income tax expenses, whatever we pay to the income tax department as income tax, like any expenses related to income tax, we will disclose under income tax expenses. Now comes the significant accounting policies. The company, whatever the company adopt, any policy is to be disclosed under significant accounting policies. Whatever the accounting policy company adopt for the preparation and presentation of financial statement, it should be disclosed under significant accounting policies. Now critical estimates and judgment. In critical estimates and judgment, we will explain by an example. This we will explain by example, that is we will disclose what we select in the useful life of the assets. If any actuarial valuation of employees defined benefit obligation is there, that is gratuity, leave encashment, anything is there, we will disclose under critical estimates and judgment. Now comes the financial instrument and risk measurements management. Financial instruments and risk management, in this we will disclose fair value measurements, In detail, we will learn under Ind AS 101 and 32 what are the fair value measurements, how we will determine fair value measurements. We will learn under Ind AS 101 and 32. Financial risk management, capital management. These are the disclosures. Now comes first time adaptation of Ind AS. If we will adapt Ind AS for the preparation of financial statement for the first time, then we will give these disclosures like exemption and exceptions availed. This we will learn in detail in Ind AS 101. Reconciliation of equities and total comprehensive income, and we will give notes to the first time adaptation. We will give notes related to first time adaptation. So if we will adapt the Ind AS for the first time, this notes is to be disclosed. Now group information acquisition and disposal, like segment information. We will give the segment information, business combination, discontinued operation, related party transaction. All these we will need to disclose. Now comes other information. Other information like contingent assets and liabilities, commitments, event occur after the reporting period, share-based payment, earning per share, offsetting financial assets and liabilities, any additional information required by Schedule 3. So these are we will discuss. Then comes how we will prepare. How we will prepare, or what are the format. What is the format of preparation of balance sheet PL account? Like previously we will give liabilities first, then we will give the asset. Now in India's financial statement, the format is changed, and we will give the asset first and liability at the bottom. In asset, we will divide the asset in two parts, that is non-current assets and current assets. In non-current, we will disclose property, plant, equipment, capital WIP, investment property, which we will learn in detail under Ind AS 40. Then we will disclose goodwill, other intangible assets, right of use. We will discuss in detail under Ind AS 116. Intangible assets under development, biological assets other than bearer plant. We will discuss in detail under Ind AS 41. Then comes financial assets. Financial assets we will discuss in Ind AS 109, 32 and 107. Then comes in financial assets. After financial asset, there is investment, trade receivable, loans. Then comes deferred tax assets, other non-current assets. These are the items which we will disclose under non-current assets. Now comes current assets. Current assets, under current assets, there is inventory, financial assets, current tax assets, and other current assets. Under financial asset, there is investment, trade receivable, cash and cash equivalent, bank balance other than three, means cash and cash equivalents, loans and others. These are the items of the assets. Then comes liability. We will say equities and liability. Under equity, we will disclose equity share capital and other equity. What are the items we will disclose in other equity? That is reserve and surplus, security premium, capital reserve, redemption reserve, revaluation reserve, debenture redemption reserve, any other reserve. All the reserves is to be included or disclosed under other equities. Then comes liability. Liability is bifurcated into two parts, that is non-current and current. Non-current liabilities and current liabilities. Under non-current, there is a financial liability, provision, deferred tax liabilities, other non-current liabilities. Under financial liabilities, there is a borrowing, trade payable, other financial liability. Then comes current liability. Under current liability, there is a financial liability, total outstanding dues, of MSMEs, total outstanding dues other than MSMEs, other financial liabilities, other current liabilities, provision, current tax net. Like under financial liabilities, current financial, we will give the disclosure of borrowings and trade payables. So in this way, we will prepare our balance sheet. Then comes how we will prepare the presentation of PL as per Ind AS. Like we will show the revenue from operation on the face of PL, then we will disclose other income, total revenue, then we will show the expenses, all the expenses, that is cost of material consumed, purchase of stock in trade, change in inventories, employees benefit expenses, finance cost, depreciation, amortization, other expenses, and total. In this way we will disclose. And then profit before exceptional items, then we will disclose the exceptional items on the face, and then profit before tax, then tax expenses, both current and deferred. Then comes profit from continuing operation, profit and loss from discontinuing, tax expenses, profit and loss from discontinuing, total. Then comes OCI. What is OCI? OCI is the extended form of PL, which we will prepare in a single sheet. This we will disclose the items which are not reclassified to the PL, like any income tax relating to the items which are not reclassified to PL, and also the items which are classified to the PL. And then total comprehensive income. Total comprehensive income means PL and OCI. PL plus OCI equals to total comprehensive income. Then earning per share, both continuing, discontinuing, and total. In by OCI. OCI is an extension of profit and loss statement. That is, in single statement we will continue the OCI. In PL we will continue the OCI. OCI, total comprehensive statement, equals to profit and loss plus OCI. In OCI we will generally recognize notional gain and loss, items to be reclassified in PL subsequently, like net investment hedge, cash flow hedge, fair value of debt securities, that is investment in debentures and bond, foreign currency gain and loss on transition of foreign operations, share of profit and loss in associates and joint ventures. Now net investment hedge, cash flow hedge, and fair value of debt securities we will discuss in detail in Ind AS 109. Now comes foreign currency gain and loss. We will in foreign operations transition we will discuss in Ind AS 21, and share of profit and loss from associates and joint venture we will discuss in detail in Ind AS 1010, 28, and 1111. And these items, any tax implication is there, we will disclose in OCI. Any tax and deferred tax impact is to be disclosed. Now item not to be reclassified to PL, like actuarial gain and loss on defined benefit obligation, we will discuss in detail in Ind AS 19. Like for example, retirement obligation, if any retirement obligation is to be paid, like gratuity, pension, is to be disclosed, not leave encashment. And then revaluation, if any revaluation of property, plant, and equipment is to we will learn in detail in Ind AS 16. We will also disclose here. And fair value change in equity instruments like investment in shares, or we will discuss in Ind AS 109. Then comes capital reserve. If any capital reserve arises due to business combination, like any merger happens, any amalgamation happens, and then capital reserve arises, we will disclose here, and we will learn in detail in Ind AS 103. Now comes any profit and loss arises due to in joint ventures and associates, then we will disclose here. And any tax effect and deferred tax on all these above items, we will give the impact in OCI. Now comes key consideration for preparation of financial statement. What are the key consideration? That is comparative information, specific disclosure required by the act, maternity, material transaction, additional disclosure requirement. Like we also give the comparative reporting of all the items, and we will restate that items period for all the items shown in the final, including notes also. So, and any if any disclosures is required as per the act, any act like any company act or any other act, it should be disclosed here. Like if any MSME act is said that any specific disclosure required by MSME act or any company act, then we will disclose it. Any material transaction which influence the decision of the user is to be disclosed. And additional disclosure requirements. Schedules are in addition to like if any merger happens, any means any specific disclosure which is important for financial statement is to be disclosed according to the accounting standard. Rounding off is also very important. If the company having a turnover less than 100 crores, then we will round off to the nearest 100,000 or lakhs or millions. But if the company's turnover is more than 100 crores, we will round it off in lakhs, millions or crores. Once whatever the unit measurement is used, it should be used uniformly in the subsequent financial statements. Specific disclosures to be made as per the requirements of acts or regulation, cross-referencing to the related information in notes to account. Cross-reference we must do from notes to the accounts. That is important. Now comes how the financial statement is divided. That is current and non-current. And what is the definition of current asset? An entity shall be classified as an asset as current when it satisfied any of the following criteria. Like if the entity expect to realize the asset or intend for sale or consumption in the company's normal operating cycle. Normal operating cycle, what is normal operating cycle, which we will discuss later. But if the company expect to realize the asset or intend for sale or consumption in the company's normal operating cycle, then it is a current asset. If the asset is held primarily for the purpose of trading, then it is a current. It expect to be realized within 12 months, then it is a current. And if it is a cash or cash equivalent, unless it is restricted for being exchanged or used to settle a liability for at least 12 months after the reporting date, then it is a current. All the other assets other than above shall be non-current. Now, what is operating cycles? Operating cycle is what? It is a time gap between the acquisition of assets for processing and their realization in cash or cash equivalents. Means whatever the time required for acquiring the asset, for its processing and its realization in cash, that time is the operating cycle. And if the company, if the asset is realized or sell or consume during that period, then the asset is said to be a current asset. And in general, we will say that if nothing is said about the operating cycle, then we will assume that the operating cycle duration is 12 months. When normal operating cycle cannot be identified, it is assumed to have a duration of 12 months. How we will compute the operating cycle? The raw material holding period, how much time required for raw material processing, raw material holding period, then WIP holding period, then finished goods holding period, then debt collection period. All these combined together, then it makes an operating cycle. Different business can have different operating cycles. In general, operating cycle is considered to be 12 months, but it may be less or more than 12 months. Like we will take the example of wine, it will take long to process that wine because it takes more than 12 months to be processed to get a better wine. We will compute the operating cycle of wine. It will take 2 years, 3 years process and make intent for sale that wine. Now comes current liability. Current liability shall be classified as current when it satisfied any of the following criteria, like asset liability is to be settled in the normal operating cycle, then it is current liability. If it is held primarily for the purpose of trading, then it is a current liability. If it is due to be settled within 12 months after the reporting date, then it is current liability, and the company does not have any unconditional right to defer settlement of liability for at least 12 months after reporting date, then it is current. Other than above, all other liability shall be classified as non-current. Then comes how we will present the property, plant and equipment in this way. Like we will first present the gross block, opening, addition and adjustment, deletion and adjustment, then closing, then accumulated depreciation on above items like line, building, plant, machinery, furniture, vehicles and total. And then we will give the addition or adjustment, deletion and adjustment, then closing depreciation, then net block, opening and closing. Disclosures or some notes related to presentation of PPE, that is reconciliation. Company can disclose the information regarding gross block of assets, accumulated depreciation, provision for impairment under previous GAAP as an additional information by way of note forming part of financial. Like company shall disclose the gross block of previous year also as an additional note forming part of financial statement. Land and building are presented as two separate class of PPE. Asset under lease shall be separately specified under each class of assets. PPE means property, plant and equipment to be used instead of tangible assets. As per Schedule 3, goodwill to be shown separately on the face of balance sheet and should not be treated as intangible. As per Ind AS 101, entity can select to measure. Entity can select to measure items of PPE intangible at the date of transition to Ind AS at fair value as deemed cost or previous any of the method, either fair value as deemed cost or previous gap carrying value as deemed cost. Deemed cost considered on the date of transition shall become new gross block. Whatever deemed cost we will consider for on the date of transition shall become a new gross block, whether fair value or previous gap carrying value. Now, how we will present present value? Means we will find out the present value of decommissioning cost. Decommissioning cost is what? That is dismantling cost. Dismantling cost of what? For example, we will discuss by example that if a company has taken a land from government for 100 years and made a building on that, and after 100 years the company has to hand over that land to the government. So the building is which is constructed on the land is to be dismantled after 100 years, because after dismantling the company should give the land to the government. So that dismantling cost after 100 years, what was the present value of that cost is to be recognized now in the balance sheet. So present value of decommissioning cost will be part of respective asset, that is for asset for which there is an asset retirement obligation. For the asset for which asset retirement obligation is there, present value of that cost is to be recognized on the respective assets. Then comes how we will disclose the right of use of assets, that is any asset taken on lease. We will discuss or we will study in detail in Ind AS 116. We will discuss the right of use of assets under non-current asset in this way, and also liabilities under non-current liability. If the liability is more than if it satisfies the definition of non-current and current, then we will disclose under non-current and current liability as lease liability. Then comes inventory. How we will disclose? Inventory shall be classified as raw material, WIP, finished goods, stock in trade, others. And goods in transit shall be disclosed under relevant subheads. And if any method of valuation of each inventory shall be disclosed separately, whether the company has accepted cost basis, FIFO, LIFO, weighted average, it should be disclosed separately. So this is the today's class of NDES 1. We will continue this topic in our next class. Uh, Thanking you for watching my video. If you like, please subscribe my channel.